Hello and welcome. Thank you for joining us on Business Incorporated. I'm Chimeze Obi Iwago. On the show today, South African Central Bank reduces bond purchases to 5 billion rand in June. Ghana's finance chief warns that years of discipline may be undone by virus. Plus, Algerian wheat growers demand help from the government. Let's begin the show with some market numbers here in Africa, which were mostly negative at intraday, except for the NSE, which rose 1.16%. South Africa's JSE index reversed Monday's gains to shed 0.17% at intraday. Elsewhere, Egypt's main index declined 0.41%, while Kenya closed negative on Monday. And in the Middle East, major Gulf stock markets rose at intraday, with banking and real estate shares helping indices in the United Arab Emirates. The Abu Dhabi index traded 0.52% up as the country's largest lender, First Abu Dhabi Bank, gained 0.9%. In Dubai, the main share index rose 0.50%, with its largest lender, Emirates NBD, rising 0.7%, and blue chip developer Emma Properties was up 1.1%. Elsewhere in the region, the Qatari index rose 0.51%, driven by a 0.8% gain in Qatar Islamic Bank, while Saudi Arabia's benchmark index added 0.32%. And in Asia, stocks there were mixed today as the Reserve Bank of Australia kept its policy setting on hold. Stocks in mainland China continued to lead gains among region's major markets for a second day after Monday's blockbuster gains. The Shenzhen Composite jumped 1.717% to close at around 13,163 points, while the Shanghai Composite rose 0.37%. Hong Kong's Hang Seng Index, on the other hand, fell 0.08% as of its final hour of trading. Elsewhere, Japan's Nikkei 225 slipped 0.44% to close at 22,614.69, while the Topix Index shed 0.34% to end its trading day at 1,571.71. South Korea's Kospi dropped 1.09% to close at 2,164 points. Over in Australia, the S&P ASX 200 finished its trading day marginally below the flat line at 6,012.90. Overall, the MSCI Asia ex-Japan index declined 0.59%. All right, let's look at the market in London. Of course, the European Commission also included the UK in its new summer forecast, even though Brexit took place back in January, and they predict that GDP will plunge by 9.7% this year, down from an 8.3% contraction forecast back in the spring forecast. Let's see how the London markets are reading this forecast, and Juliana joins us now. Hello, Juliana. Good afternoon. Well, the EU predicts deeper UK recession even after Brexit. Are the markets following that forecast?
Good afternoon, Chimeze. No, sadly not. The information we received from the EU is pretty similar to what we've received from the OECD, the Bank of England, and the UK government's own budget for national responsibility. In fact, the information coming from the EU is about 9%, which is much lower than the government's own predictions at about 15% this year. But I've got to say that what seems to be moving the markets this afternoon, this intraday, is the latest figures from the British Retail Consortium, which sadly showed that last week footfall in UK shops was down 49.6% year on year. Now, that's a really big disappointment for the government, especially because this actually includes Saturday. And of course, we know Saturday, Super Saturday, 4th of July, Independence Day, was dubbed to be the day that we'd really see lots of crowds out in the shop. And because restaurants were opening in some of these really big department stores, there had expected to be a lot more people out shopping, and the data reveals that isn't the case. So clearly it's going to be a very slow, long road to recovery for Britain's already fledgling high street, and that has impacted the FTSE. The all share is down 1.27% at intraday. The FTSE 100 is down 1.24%, and the FTSE 250 is down by 0.85%. In currencies, the pound is also down on the US dollar by 0.02%, up on the euro, though, by 0.25%, and up on the Japanese yen by 0.29%.
Well, wheat bread was the top faller on the FTSE 100, down 4% this morning, despite reporting a pickup in demand for holiday bookings in the UK's region. What's up with wheat bread?
Well, Whitbread are in a similar case to all hotel chains across UK, Europe, and I presume across the world, where they had to lock down their hotels. So they just announced this morning their Q1 trading update, and no surprises really that their revenue was down by about 80%. They have hundreds of chains of Premier Inn, which is a really popular local hotel here in Britain, that were locked during lockdown. The reason why they even had a 20% boost in revenue, or a 20% profit, is because they had about 35 chains still open for key workers. But Alison Britton, who is their pretty popular chief executive, she's been saying, you know, no need to be alarmed, that of course we were expecting this. We were basically closed down in Q1. We should see a resurgence in Q2. They've already said that they are starting to see a lot more regional interest. Of course, as soon as Boris Johnson, the Prime Minister, allowed people from within England to start travelling around the country, they said they are seeing an uptick. But there are, of course, major concerns about international travellers and business travellers, which, of course, are not doing it at the moment. Everybody is Zooming or using some other video remote social media sites to have their discussions. And for Whitbread, that's their bread and butter. So they are hoping that will pick up later today. But as you said, their shares fell 4.5% as soon as they made that trading announcement in early morning.
And former stock market darling Boohoo is having another rough day after revelations that its Leicester-based suppliers have been paying workers below the minimum wage and ignoring COVID-19 guidelines. It plunged 23% yesterday. How is the stock doing at intraday today?
Yeah, well, at intraday, the stocks are down about 35%. This is a massive blow for Boohoo, as you said, which was the darling of online fast fashion. In fact, I think a couple of weeks ago I was talking to you about them because they had absolutely surged. Our viewers in the UK will be familiar with them, because if you go on any public transport, all you see is these C-list or Z-list celebrities flaunting around on their pretty skimpy clothing. But they've been caught up in this current corporate governance row, which has not just got them in trouble, it's also got a lot of other companies in trouble, but particularly when it pertains to Boohoo.com. The issue is a factory that they use in Leicester. We know Leicester was recently the subject of a local lockdown in Britain, and a lot of these COVID-19 spikes was said to be coming from textile factories. There are allegations that one or two or a few of these factories are making clothes on behalf of Boohoo. Working conditions are poor. They're paying staff below the minimum wage in this country. I think they're paying staff £3.50 an hour, which I believe is the equivalent of about 2,000 naira per hour. Priti Patel got involved, the Home Secretary. She said that she will be making an investigation. And since this news has erupted, £1.5 billion worth of the market value of Boohoo has literally been wiped off in 48 hours. There have also been concerns about the reaction from Boohoo's owners. They're young playboys. There's no problem with that. But I believe they put out some tweets that were not apologetic enough, which really offended the shareholders. So Boohoo will obviously be hoping that they can turn this around, but being linked to modern slavery, especially at a time when how you treat your workers is such a toxic discussion point here in the UK, is not fair and good for them. And it's going to be pretty disappointing because, as I said, you know, when retail is pretty much on the brink of collapse here in the UK during the lockdown, they seem to weather that trend, and their online sales were surging.
Well, thank you very much, Juliana, for those updates this intraday. Enjoy the rest of the day. And stock futures pulled back in early trading today after a solid rally on Wall Street to start the week. Futures on the Dow Jones Industrial Average indicated an opening drop of more than 250 points. S&P 500 futures and Nasdaq 100 futures also traded in negative territory. The overnight action followed a strong day on Wall Street that saw the Dow jumping more than 450 points. The S&P 500 gained 1.5% on Monday for its fifth straight positive session, while the Nasdaq rose 2.2% to hit an all-time high. The market continued to shrug off a continuous rise in coronavirus cases across the U.S. The Labor Department will release the May figure for job openings today. The government's job openings and labor turnout survey is a month behind the more closely followed non-farm payrolls report, which showed a surge of 4.8 million in June and a 2.7 million jump in May. And back here on the continent, the South African Central Bank has reduced its government bond purchases to 5 billion rand in June, half the monthly average, bringing its bond holdings to 35.9 billion rand. In late March, the Reserve Bank began a series of emergency liquidity measures, which included extra repo auctions and 275 basis points worth of lending rate cuts to ease the stress on banks and capital markets caused by the coronavirus pandemic. The bank has since slowed those support measures as local financial markets recovered, resisting calls from Labour and some economists to resort to full-blown quantitative easing style funding of government's gaping budget deficit. And in Ghana, the budget deficit for 2020 is expected to swell to more than double the legal limit because of the impact of the coronavirus on the economy, undoing years of fiscal consolidation that was supposed to mark the end of persistent financial bailouts. The Finance Minister Ken Ofori-Atta said the financial gap is forecast to widen beyond 10% of gross domestic product from an adjusted outlook in March of 7.8% of GDP prior to the onset of the global pandemic. The West African nation expects a shortfall of 4.7% in line with legislation passed 2 years ago that the deficit shouldn't exceed 5%. Economic growth is now projected at 1.2%. That compares with government estimate of 1.5% at the end of March and with an initial forecast of more than 4 times that. All right, let's look at the domestic, the commodities market space and talking about oil now. Prices cautiously rose in early trade today with the major producers sticking to supply cuts, but gains were capped as U.S. coronavirus cases surged, potentially hampering a recovery in fuel demand. U.S. West Texas Intermediate crude futures climbed 13 cents to $40.76 a barrel, recouping a 2-cent loss from Monday. Brent crude futures rose 7 cents to $43.17, adding to a 0.7% gain on Monday. Gold prices edged higher in early trade, hovering near an 8-year high as concerns over surging coronavirus cases around the world kept billions safety demand elevated. Spot gold was 0.1% higher at $1,784 an ounce, just $3.97 shy of a near 8-year high of $1,788, which was hit last week. Okay, let's take a quick look at the European markets, which retreated this morning as concerns over the threat to economic recovery of new coronavirus cases in the U.S. and weak German data by the BRICS on Monday's rally. Let's get to know some of the market drivers with Conrad Bussen. Hello, Conrad. Good afternoon. Well, according to the latest economic forecast by the EU Commission, the European Union is facing a recession this year, which are much larger than anticipated until now. And Germany's manufacturers seem to be part of the problem and not the solution. What's going on?
That's true, Jimmy. Germany's industrial production increased by 7.8% in May. Sounds like a big number, but it's actually not. The slump before that had been much larger. Not even a quarter of the slump of the industrial production here in Germany, which happened in April, was made up for. So the recovery is going on much, much slower than anticipated up until now. In terms of the European Union's economic forecast, it looks like this. The gross domestic product in the European Union is expected to be shrinking 8.7% this year. Germany's economic forecast is a decline, a contraction of 6.3%. But France and Spain, very negative number, a minus 10.6% for France, minus 10.9% for Spain, and the Italian economy is expected to contract by 11% this year. Definitely all this means that the pressure remains high on our policymakers to come up with more, stimulus legislation. For example, this huge European Union recovery fund that's currently in the making.
All right, thank you very much, Conrad. I'm afraid we'll just have to leave this conversation here, I'm sure, but tomorrow we'll have more time to look at this issue and how it's impacting the market. Enjoy the rest of the day. We'll take a quick break, and when we come back, we'll look at our domestic commodities market. Just stay with us. FAO's global rice production forecast for 2020 is now pegged at 509.2 million tons, up 1.7% from 2019 and 400,000 tons above June's expectations. Now, this month, the United States Department of Agriculture estimates that the world rice production 2020-2021 will be 501.96 million metric tons. Rice production last year was 493.79 million tons. And what will these projected rise in rice production mean for Nigerian rice market? Let's talk to one of the research analysts with financial derivatives company, Nneka Okolo. Hello, Nneka. Thank you very much for joining us. Good afternoon.
Hello, good afternoon.
Now, global rice production for 2020-2021 is estimated to rise to about 510 million tons due to a tentative increase in rice production in India to about 120 million tons. Do you think that these global factors will affect Nigeria's rice output this year, especially in the light of the pandemic? And if so, what are the implications?
Well, rice is a key staple globally and more so for Nigeria. The federal government, as an encouragement of domestic rice production, imposed a ban on imported rice. To we are aware that rice is being imported unofficially. In this being said, in the long term, we expect rice to be in ample supply, both from local and foreign sources. And what this would imply, since cost of importation has gone up, is that rice cost could edge higher in the near term.
Retail price, of course, rice has increased by over 100%. That's since July last year to about 28,000 naira. Some would even buy 30, from a one-year low of about 14,000 naira. What are the factors responsible for this astronomical jump at a time when Nigeria is supposed to be self-sufficient in rice production?
Well, first of all, this jump is generally visible across other food staples like yam, garri, and so on. On one hand, we have the effect of the announcement of the country venturing into a 14-day lockdown that induced panic demand for food items, including rice, which is a major staple in Nigeria, as I mentioned earlier. Although this panic demand was short-lived, based on the theoretical idea that of the direct relationship between demand and price movement it's quite obvious that the panic demand caused and supported the price gain. On the other hand, there was increase in logistics costs, with traders seeking to gain profits amid the whole market uncertainty. It's easy to say that the additional logistics cost was appended to the price of rice in retail markets. Therefore, these two factors, panic demand and increase in logistics cost, are the major contributors to the increase in the cost of rice.
Food inflation is at 15.09%, and rice constitutes 8% of the food basket. Rice is not an imported commodity. Therefore, there is no exchange rate effect on the commodity. So why is the rate of change in the price of rice much higher than the food inflation rate?
Well, rice is a single commodity, and we would also take into consideration the fact that the food inflation rate is computed based on the prices of a basket of commodities. So now it depends on the individual weights of other commodities in this food basket. If despite the significant contribution of rice to the overall food price index, if some of these other commodities weigh more on the overall food price index, then those commodities remaining flat or declining during this period caused the modest increase in the food inflation rate, in the food price index, as compared to the significant increase in the cost of rice.
All right, thank you very much, Nneka, for your time. Nneka Okolo is one of the research analysts with Financial Derivatives Company. And as Algeria's harvest season begins, farmers complain of little help from the government with storage and distribution of locally produced wheat. Meanwhile, the country has imported more wheat during the first quarter of the year, raising the import bill. Let's watch this.
Farmers and investors said that Algeria, which is the largest buyer of European wheat, wouldn't have to rely on imports if the government provided more support for its local industry. Algeria has been trying to cut spending on cereal purchases and other goods to ease the impact of a fall in energy export revenue, which is a main source of state finances.
Despite the lack of rain, we have harvested enough wheat. If they, the government, provide us with the means and places for storing the wheat, we will not need to import from abroad. That is because we own the land and we are only lacking in storage space as well as the material means.
While the land and skilled labor exist, Yusuf said workers are increasingly avoiding the agricultural industry due to the significant lack of resources.
The state must support us by any means and with money. Agricultural land is available. There are farmers to cultivate the fields. We don't want them to import wheat. Our wheat is enough for all of us.
Despite attempts to cut back, the import bill for durum wheat, soft wheat, semolina and flour reached $629.50 million in January to March, and that's up from $614.39 million in the first 3 months of 2019, according to customs figures. Algeria is among the world's biggest wheat buyers, sourcing most of its supply from France. It spent about $3 billion on wheat imports last year, including durum wheat, flour, and semolina.
With that, we draw the curtain on today's edition of the program. Thank you for watching. I'm Chimeze Obi Iwago.